Hi, Ian and Amber here with a new edition of Monday Market Insights right here on the Winning Investor Daily YouTube channel, home of Ian King's Strategic Fortunes monthly research service. Thank you everyone for tuning in this week. Please don't forget while you're here to please give us a thumbs up if you do like the content of this video and find it helpful. That really does help support this channel. And while you're at it, giving us hopefully that thumbs up, please hit that subscribe button because that also gets you tuned in when we have a new video drop. So in these weekly videos, Ian and I plan to cover general investing questions, our take on the latest financial market economic type developments, as well as Ian's really great niche, the crypto market, and as well as tech trends going forward. So that's the plan. So hello, Ian. Good morning. Happy
Good
Monday.
morning. Good morning, Amber. I love the energy you're bringing here on a Monday.
Oh, yes. Mondays are the new Friday for me now. Get ready for the markets, hit the ground running. I hope you had a good weekend.
I did. How about yourself?
So yeah, I had a good weekend. It was a productive weekend, productive with a capital P.
Awesome.
So I thought we'd get started, Ian, with some general economic releases. Is that okay with you to cover what people can expect for the week ahead or
Yeah,
whatever?
we got a busy calendar. I mean, we had that release on Friday, which we're going to talk about, and this is going to be a busy week. So let's get at it.
Okay. So yes, it's a big week for economic releases, especially where inflation monitoring is concerned. July's consumer price index month over month and year over year releases actually post on Wednesday, August 10th at 8:30 a.m. Surveys actually show potential decline in these prints. July's producer price index PPI final demand month over month reading actually posted on Thursday, August 11th at 8:30 a.m. And surveys are predicting a decline there. And August's preliminary reading for University of Michigan Consumer Sentiment Index posts Friday, August 12th at 10 a.m. And surveys are predicting a slight uptick, a slight rise in consumer sentiment. So that's the calendar for this week. I can say there have been encouraging signs that inflation is ebbing, Ian. Gasoline prices have fallen, actually slowing growth concerns point to the possibility of energy usage will decline. And I can say as a result, investors really have been moving away from oil commodities as seen in the West Texas Intermediate futures, which are down about 10% within the last week. And Brent oil futures are now hovering around $93 a barrel, down down to around 106.50 a barrel since a week ago. And good news, AAA is showing that the average price for regular gas has dropped for 55 days in a row. Can you believe that, Ian? So we'll see how this goes.
I mean, it's still high though, but it's still a couple dollars higher than it was a year and a half ago. But it's nice to see the price of gasoline trending lower.
It's trending lower. And guess what I noticed at my local Costco? The lines are getting a little shorter.
Oh, okay. That's nice as well. I just have to say something about this release of the consumer price index.
Sure.
When I worked on the trading floor way back in the day at Solomon Brothers in fixed income, there was always one data point that all the traders were focused on, and everyone would huddle around their Bloomberg screens, at 8:30 in the morning for the release, and then it would be total pandemonium. The CPI is that number right now. Typically, it's been the jobs number, which we saw on Friday, which came in way ahead of expectations. But the CPI is so important. And let me just say why it is because last month, the reading came in at over 9%. We had a 9 handle. It's the first time that inflation was this high in 40 years. And, if I told you, Amber, inflation is running at 9%, you'd be like, oh my God, get me out of the stock market, right? But what happened was the market narrative shift to, okay, that was the peak. We had a 9 handle, and now we're not gonna go double digits, and now we're gonna start to see inflation trending down. And as you mentioned, all the key commodities, or many of them that make up the index, are starting to go lower. And so it's important that this number comes closer to an 8 handle than a 9 handle, because we saw a nice rally over the course of July, given that the new market narrative is inflation has peaked, it's coming down, the Fed's doing its job, and we're heading in the right direction. So, this number is either going to kind of stop us in our tracks and cause a bit of a market sell-off, which I think the lows are in for now, or if you see something below an 8 handle, I think you're going to start to see an acceleration in these tech stocks, and a lot of the hedge funds are going to feel like they're missing out on what's ahead of us. So it's sure going to be a consequential number this week.
It certainly will. I'm glad that you pointed that out. And also, can we talk about the producer price index where inflation is concerned? So just for everyone who may not know, this index actually measures a change in prices paid to U.S. producers of goods and services. And it has shown it may have peaked, Ian. And I can also note that import prices, which are prices for goods and services purchased from abroad by U.S. residents, have seen disinflationary or slowing of the pace of price of inflation due to a strong dollar. And so it's just interesting to see all these different stats come in. I know it's premature, a little preliminary, but it's something in the right direction. It's not going to stop the Fed from ratcheting rates for the foreseeable future. But I know you may mention this, but I have a chart from Work, which is just a forecast of where interest rates will be, maybe, no, there's no will, maybe in 2023. And this Bloomberg chart actually predicts that we may see a faster rate cuts or easing into 2023. So what do you think about that? Do you think that's on point?
So, what Powell said after the last 75 basis point increase is they wanted to basically front load their interest rate increases to slow the economy down. And in doing so, that would slow down inflation. Insofar as, you've seen energy prices come down, it's worked. Financial conditions have tightened, which means it's harder to get a mortgage. So you started to see a sharp decline in housing prices. New home starts was down last month, or is at least slowing down from where it was. So the amount of capital and credit that's being deployed in the economy is starting to slow down. That should be good for inflation. I mean, do I think the Fed is going to be rapidly cutting interest rates next year? It really comes down to whether or not we go into recession and how deep that recession is. The jobs number that we got on Friday, Amber, is not pointing to a recession.
No.
Economists expected 250,000 new jobs increase last month. We got, 500,000 and also 5% wage growth. So we could be in a situation here where inflation is falling, but the economy is continuing to grow. And a lot of the inflation concerns, either supply chains that were locked up because of COVID, or just tightness in the oil markets because of fears of what's happening in Russia and Ukraine. But a lot of those psychological factors seem to be working themselves out. And that's why I think that we've seen the bottom for the year in markets. And a lot of people will argue with me and say, this is a really controversial view. But, this is one of the most hated rallies of all time. Everyone you talk to is predicting this is just a bear market rally and we're going to roll over and we're going to see new lows. When that is general sentiment, that usually means we bottom. And I just want to direct readers back to the COVID crisis, because we had a 35% sell-off in 2020, and there was so much uncertainty in March and April. And, a lot of people were calling for a double bottom, which means that after we started to see a rally in April, that the markets were going to roll over and test their lows. I was the exact opposite. My thinking is always like, when everyone's calling for a double bottom or just a bear market rally, the lows are probably in. And these are the same investors that are going to wind up paying higher prices down the road in the future because they've missed out on being able to locate that inflection point, which I believe that we've seen already in the markets as inflation is coming down. So, whatever happens this week with the inflation numbers, we could see a market sell-off, but because a lot of that uncertainty that we had that caused that market, disaster earlier this year is behind us. I think that any sell-off at this point is a buying opportunity if you're looking 1, 2, 3 years down the road.
That's music to my ears. And I
want to show a very important chart I have for readers. If you would allow me to just share my screen here, I want to show everyone a chart of the QQQs. So this is the ETF that tracks the NASDAQ. And these are monthly candlesticks. So this is a long-term chart. If I zoom out here, you can see this goes all the way back to 2000. And we had a very technical signal last month, which is called a bullish engulfing candle. And what that means is that basically the low of the month was lower than the prior month, and the high closed higher than the prior month's high. And this is a signal of a market reversal. We actually had one here in December 2020, which led to a pretty significant rally. We had one in March 2020 at the bottom of the coronavirus crisis. And then if you go back, we had some signals here back in 2011, which is, when stocks had fallen because of financial crisis and were coming out of their lows. And then the biggest one of all time happened basically in October of 2002, which was the bottom in the NASDAQ. And if you had bought the NASDAQ back here on this bullish engulfing candle at $20, if you bought this ETF, you were looking at a 20x return over 20 years just by buying a passive ETF. So I just want viewers to be cognizant of this bullish engulfing pattern that, we see maybe once every couple of years, that suggests that a stronger rally is ahead of us and the lows are behind us.
I love that chart, Ian. Really telling. So I would like to actually ask you a question on crypto.
Okay, let's rock.
Yes, actually, in our Slack channel this morning, you posted a great comment from Gary. Could you comment on that one, Ian? I'd like to see what readers say and what you think about this as well.
Oh, sure. So I guess like a week ago, I was talking about different platforms where you should be able, put your crypto and where you should and shouldn't. And my view is that Coinbase is the safest place. They're very well capitalized. They don't engage in a lot of these borrow and lend protocols, which we've seen Celsius and BlockFi and other crypto lenders getting problems with because they over leveraged. It's a very opaque market where they take customer deposits and they lend them out for a high return and then pay you maybe half of that return. And my comment was, I would just be really worried about investing in Celsius. And I think what an astute reader pointed out is that, he said that I insinuated that Celsius is out of business. And he says it's not going out of business. It's going through Chapter 11 reorganization, just like GM and Delta did some time ago. And those two companies not only survived, but they now thrive. Okay, so I appreciate this comment. The one thing that I'll say about Celsius is that in the financial business, trust is everything. And when you're a company that has taken customer deposits and, done some, shoddy lending with them and gotten yourself in trouble and over leveraged your firm, that trust is not coming back anytime soon. So if you're a customer that has a choice to put your crypto assets on an exchange like Coinbase or FTX that we know is really well capitalized, or Celsius, most likely you're going with the safe bet. Now, Celsius could come up with some type of high yield scheme where they're offering you more money and try to get more deposits in there. And that could benefit them in the future. But right now, my point is that trust is really everything in this business. And obviously in the airlines, there's some planes that have accidents and then people continue to fly those planes in the future. But in finance, I think the substitution switch is a lot easier. I see Alex doesn't necessarily agree with my answer, and that's okay. Not everyone is going to agree with what I say. But, my point is that if you have crypto, keep them on Coinbase and FTX or store them in a Ledger Nano X, have a diversified way of securing your assets, and just be careful about these high yield lenders that entice you with really high yields, but you don't know what they're doing in the background. And we saw this big liquidation and a lot of those people got their assets frozen, unfortunately. But the market has moved on from then since then.
It has really moved on. Okay, I'm glad you covered the Celsius subject. So Ian, did we get I saw you also posted that we received a comment from I want to say Eduardo. Is that
Eduardo? Yeah.
So I like to read that out. Thank you, Eduardo, for writing in and posting to our YouTube. Eduardo wrote, I had a slice of a very sweet pie during the bull run, and it's due time to thank you all for the guidance you have abundantly shared. Thank you, Ian, and all your staff. Please keep on giving. Isn't that nice? That's wonderful.
That is so nice. And I've never heard anyone say a slice of very sweet pie. And that's a really nice way to put it. So thank you for that comment, Ricardo. We try our best, to give you the most actionable investment ideas we can here.
It's true. And it's a good way to start a Monday with a sweet comment like that.
That's true. Positive news.
Positive news. And speaking of positive news, Ian, I'd like to touch on a megatrend topic for this week that really caught my eye. And
Okay.
it's still all about electric vehicles, EVs. So as a lot of people know, Tesla wrapped their Cyber Roundup event last Thursday. And some of the key takeaways were that Elon Musk revealed that another gigafactory location may be chosen later this year. The EV maker also plans, they had plans to build 10 to 12 gigafactories altogether. They also go ahead, the shareholders passed a 3-for-1 stock split, while Tesla's advanced driver's assistant system, FSD, full self-driving beta, is actually poised to rapidly grow. And Musk actually says, quote, "We're now at over 40 million miles. And I suspect by this year, we're going to see well over 100 million miles. And we're still tracking very much to have widespread deployment of FSD beta this year in North America." And as I mentioned, Ian, in my Megatrend Thursday video on July 21st, Tesla is in dire need for more lithium refiners to come online and get down to the business of making ready-to-use lithium to power batteries and EVs like Tesla's. And so it's a very real need. And I'm seeing more news on this in the wires, especially this morning. That's why I'm bringing it up, because people are being, it's a buzz. People are talking about it. And according to Musk, when speaking about companies focusing on lithium refining, he says, "You can't lose. It's a license to print money." How cool is that? So
yeah, I mean, lithium is like the 21st century oil, right? I mean,
yes.
we in the 20th century, it was all about where is oil, how can we get it out of the ground, how can we refine it and put it in our cars, and now it's all about lithium. And the biggest shift here is this crossover idea. And I just want to explain to viewers that don't really understand the EV thing and why are we going to need EVs in the future and why is it going to be more competitive. It all comes down to cost. 15 years ago, to build an electric car, there was nothing available for under $100,000. It cost a fortune. And now, I mean, not only Tesla, but there are other automakers that have cars, EVs, full EVs under $30,000. And then if you add the tax credit and incentives on top of that, the total cost of ownership, also, you're not paying for gas every time you drive around. Total cost of ownership is going way down. And it just becomes an economic calculation. And that's why I think electric vehicles will be an even larger part of new car sales than even analysts predict. The common narrative is that by 2030, I think only 50% of new car sales are going to be electric vehicles. It's about 5% now. Wow. In reality, I think this number is going to be closer to 90%, even 100%, because why would you buy a gas? First of all, EVs are so much more fun to drive. You step on the pedal and it just goes. Second of all, I've got a Jeep hybrid that gets 25 miles per charge. Okay. And I've had this car for a year and I've maybe filled up the tank 5 times. What? Right. I just charge it every night. It's great. Yeah. And, it's like, I'll never go back to driving an internal combustion engine unless it's like, an old Volkswagen or a Porsche or something like that has just a classic engine. I think every new car that I'll purchase will be an EV in the future. And it's just going to come down to the economics. It's just going to be cheaper to buy an EV than it will be an internal combustion engine. And so that is basically the death knell for the internal combustion engine. And I know that you're a big gearhead, Amber, and you might be sad that the gas guzzler is gone, but this is just the reality that we're living in.
It's the reality. And I can tell you, Ian, I was at church this weekend, and in my church's parking lot, it's becoming filled with Teslas. So it's adoption is the word there. People are buying them. But I have to say, I still have a gas guzzler. But for me, I like to hear it. It's a very loud engine, and I just have a thing. I'm a gearhead, so I just love to hear this engine noise, and that's what I have. It's a great exhaust. So,
I'm sure that there will be a software deployment from Tesla at some point that allows you to hear that sound inside your car, to mimic any sound eventually. I'm sure that's something that they'll have in the future for those of you that miss those loud cars. Me personally, I don't like it when somebody drives by my house,
No.
in a car that's louder than the music I'm watching or listening to, or the TV I'm watching.
Nothing that annoying, but for me,
Right.
it's a pop, pop, pop. I hear that's what I like to hear. So
Oh, okay. Fair enough.
I'm decelerating, pop, pop. So that's how I roll.
Uh-huh.
So also just one other thought on lithium refining, Ian. I just wanted to point out, I believe you have some lithium play in your portfolio. Is it, I think we can reveal it. Maybe you let me know, but Livent, is that one of them?
That's in our small cap portfolio. But then also in Strategic Fortunes, we have MP, which is Mountain Pass, and they don't refine lithium, but they have a mine for what's called neodymium, and this is a material that's used in magnets, and you can't run any electronic device, a car or a drone, without having magnets in it. And this is the only producer in North America. Right now, we get all our neodymium and rare earth production out of China. And so when I looked at the company and looked at the stock, I just thought that this is a company that is a matter of national security, because we can't continue to, have economic competitiveness with China when we need them for all the future, hardware and technology that we're going to have. So I've always thought this stock was just a kind of a no-brainer, especially the valuation was traded when we first recommended it. So that I think is also just as big as lithium, because there's more kind of commodity components that go into making batteries. But yeah, I'm glad you brought that up.
Oh, you're welcome. So just if anyone who's really interested in Ian's services, he has a plethora of cutting edge type of investments, like we just mentioned with Livent, things that are focused on the future. So if you're really interested in learning more about how Ian thinks and his investment style, and get in on his service, so you're in at the ground floor, really great prices for future trends and their gains going forward, please click the bull icon right here over my shoulder to get all those details so that you are in it to win it. You never know. So, Ian, I think that covers our topics for this week. I like to just point out, if anyone has a question that they like to see answered on next week's Market Insights video, we'd be more than happy to answer them. You can post them in the comment section of this video right below, or you can feel free to email us at winninginvestordaily@banyonhill.com. So that concludes this week, Ian. Oh, just another note, if you want to follow Ian and us on Twitter, we are on Twitter live all the time, and you can find us. Ian is at @InvestWithIan, and I am at A Lancaster Guru. So Ian, that's it for me. You have anything more you'd like to add for this week's video?
Well, I think we covered a lot of ground here today, Amber.
I think
Thank you for this great discussion. I look forward to next week.
I do too, Ian. Always good to try and start the week off in a good foot.
That's true.
So I wish everyone a wonderful week ahead, and we'll keep you posted via Twitter or through, if you're a subscriber, through emails of any of the latest developments affecting your stocks and the overall market. So until next time, we wish you a good week.